Hi everyone, welcome back to my channel. In today's video, I have followed the same format, 3 accounting questions and 3 corporate finance questions, each with real interview style twist. Make sure you stick around and drop your answers in the comments to the question I ask in between. It's a great way to practice thinking under interview pressure. Also note the difficulty level is going up in this series, and that's intentional. These are the exact type of questions that show up in private equity, investment banking and corporate finance roles, where you can easily face 3 to 6 rounds of interviews. And before we dive in, if you need any help preparing for your own interviews, just comment finance below and I'll do my best to guide you. Let's start.
You have seen revenue on the income statement and accounts receivable on the balance sheet, but interviewers go deeper. They ask what's the difference between accrued revenue and deferred revenue. Here is the basic idea. Revenue is recorded when it's earned and the company has delivered the product or service, not when cash is received. And that is accrual accounting. Watch the above linked video to know more. Now, depending on the time of invoicing and cash collection, the activity shows up either as accrued revenue or accounts receivables or deferred revenue. Think of a consulting project completed in March, but the invoice is going out in April. So here the company has already served the customer by delivering the project. So they have earned the revenue, but they have not billed the client yet. That's accrued revenue and it's an asset. Earned but not billed yet. Now imagine they have done the work and sent the invoice, but the customer has not paid yet. So they have earned the revenue and billed the client, but customer has not paid yet, so the cash has not come in, and that's the account receivable. It is also an asset. And now finally picture the opposite. So customer has paid 12 months subscription fee, but the company has only delivered 1 month of service so far. So the company has collected cash but not yet earned it. So it's a liability for a company, and this is known as deferred revenue. You can see deferred revenue is sometimes called as contract liabilities. Similarly, for accrued revenue, you can see sometimes it is known as unbilled revenue and accounts receivables as billed revenue. And all these three appear on balance sheet. Now let me show you the TCS balance sheet. TCS is a consulting services company, so they naturally have these line items. If you see trade receivables billed, this is accounts receivable. Trade receivables unbilled, this is accrued revenue. And unearned and deferred revenue on the liability side. Interviewers love this question because it shows you understand the timing of revenue and the cash flow. And this is critical for working capital analysis, forecasting and valuation. So the key takeaway is accrued is earned but not yet billed, and it's an asset. Account receivables are billed but not yet paid, asset. Deferred, cash received but not yet earned, so liability. Moving on to the next question on inventory accounting. Investor asks, in an inflationary environment, which inventory valuation method, FIFO or LIFO, which is first in first out or last in first out, results in a higher net income? These questions are generally asked by global PE funds or IBs which have presence or exposure in US, because the optionality of switching to LIFO is only available as part of US GAAP. Let's start with an example because it makes this concept so much easier to see. Let's say a company buys 100 units at $10 and later another 100 units at 12. It then sells 100 units to customers. So now the big question is, which inventory cost do we take to calculate COGS, the older $10 or the newer 12 ones? And that's exactly LIFO and FIFO decide. Under FIFO, which is first in and first out, we assume $10 items were sold first. So for us, the COGS would be 10 into 100 units, which is 1000. And the ending inventory, which will appear on balance sheet, will be the newer inventory, which is 12 into $100, right? So our COGS will be lower in FIFO. As a result, we get higher net income. So in an inflationary environment, this means lower COGS and higher reported profit. When we say inflationary environment, this was the inflationary environment. We bought 100 units at $10 and later because of inflation, the price went to $12. So we can see in the inflationary environment, we get higher net income in FIFO method. Now let's see LIFO, which is last in and first out. So we assume the newer items which were costing us $12, COGS will be 100 into 12, which is 1200. The remaining inventory is older, so it is 10 units, so ending inventory will be 1000. In an inflationary environment, this means higher COGS because we are selling the newer item and results in lower net income, but also lower taxable income as well. If prices are falling instead of rising, the effect flips. In that case, LIFO gives us lower COGS and FIFO gives us higher COGS. And very often interviewers don't just say you to explain FIFO versus LIFO. Instead, they will give you an example saying, let's say a company buys inventory at $10 and then at 12 sell 100 units, show COGS and ending inventory under LIFO and FIFO. So being ready with this example and these answers means you are covered no matter how they phrase the question. When I was interviewing for an investment banking role, specifically for the M&A team, I was asked this classic question, what is goodwill? Interviewers ask this because it's right at the heart of M&A accounting and purchase price allocation. Let's break it down. So goodwill is an intangible asset and they appear on the balance sheet only when one company acquires another company for more than fair value of its net asset. So that's the premium paid for things like brand reputation, customer relationship, or synergies expected from combining the business. Let me give you a very simplified example. Let's say company A buys company B and company B net assets are worth 80 million on paper, but company A paid 100 million to acquire it. So that is extra 20 million which company A has paid for company B. And that extra 20 million paid above the net assets becomes goodwill on company A's balance sheet. Now let me show you a real world example from Microsoft's balance sheet after it acquired LinkedIn. If you look here, the line called goodwill, this represents the premium Microsoft paid over LinkedIn net assets when it bought the company, the extra value for brand, customer base and expected synergies. So here is the takeaway. Goodwill is purchase price minus fair value of net assets acquired. And remember, goodwill appears when one company acquires another company, and there is no other case when goodwill will appear on the balance sheet.
We have now completed the 3 accounting questions. If you are finding this useful and it's helping you, make sure to like the video and subscribe. That way you won't miss the next part of the series.
One question you almost can't escape in finance interview is what is WACC? The weighted average cost of capital. I'll keep WACC at a high level here, just the parts you need to crush this in an interview. WACC is average return a company must earn to satisfy all capital providers. For now, let's just assume equity and debt. Now think of a company funded partly by equity and partly by debt. Equity investors are expecting a return, let's say 10%. Debt holders are expecting a return, let's say 6%. Because interest is tax deductible, we use the after tax cost of debt when we blend it. So if the company is, let's say 50% funded by equity and 50% by debt, it needs to keep both groups happy. So we take a weighted average of their required returns and this is known as WACC. So in formula terms, WACC is E by V, which is percentage of equity holders into their cost of equity. This is percentage of debt holders and their required return, and this is because of after tax, because this is tax deductible. So if we put all this in our formula, we will get WACC as 7 to 8%. This is the minimum average return the company must deliver to satisfy all its capital providers. Interviewers love this question because WACC is not just a formula, it is a hurdle rate. For example, if the returns are above WACC, the company is creating value. If the returns are below WACC, the company is destroying value. That's why it is used as the discount rate in DCFs and as the benchmark for investment decision. Next, we will zoom in on one piece of WACC, which is cost of equity, usually calculated using CAPM model, capital asset pricing model. So cost of equity is simply the return that shareholders require for investing in the company. Remember, equity holders are last in line to get paid, so they take more risk and hence demand higher return. The most common way to estimate cost of equity is to use KPM model, which is capital asset pricing model. And here is the formula. So this is the cost of equity, this is risk-free rate, and generally it's the government bond. This is beta, how risky the stock is relative to the market, and this is equity risk premium, which is the extra return investors expect from stocks over bonds. Let's say suppose we have risk-free rate of 4%, beta of 1.2, and equity risk premium is 5%. So in that case, our RE will be 10%. If we put these numbers in this formula, we will get cost of equity as 10%. And that 10% is the return equity investors demand given the risk. Now, beta is the part that often confuses candidates. In this formula, it's just an input, but in interviews, they will drill deeper and ask what exactly is beta and how would you estimate it for an unlisted company. And that is our next question. So what exactly is beta and how would you estimate it for an unlisted company? Let's break this down step by step. Every company faces two types of risk. One is systematic risk and the other one is unsystematic risk. Unsystematic risk are company specific events like product recall or a factory strike, and the key is you can diversify this away. For example, say you own two stocks. One is an airline and it faces a strike that hurts its profits, so the stock falls. The other is a tech company that just launched its new product, its stock rises. So these events are unrelated, so in your portfolio, one loss is offset by the other's gain. As you add more stocks across industries, these company specific ups and downs cancel out. And hence, these are unsystematic risk, and we say that it's diversifiable. Systematic risk, these are economy wide shocks like inflation, interest rate, or recession. These risks hit all the companies at the same time, so you cannot diversify them away. And beta measures exactly this systematic risk, how sensitive a company's stock is to overall market movements. And here is how to read beta. Beta is equal to 1, stock moves in line with market. Beta greater than 1, more volatile than the market, riskier and higher returns. Less than 1, less volatile. Here is a quick check for you. Can beta be 0 or negative? If yes, what does that mean and which kind of securities or commodities might show that? Drop your thoughts in the comments. Remember, when we say the market, we usually mean a broad index. So here when I'm saying it moves with the market, I mean a broad index like S&P 500, Dow Jones, Sensex or Nifty. Basically a diversified basket of stocks that reflects the economy movement. Now let's tackle the second part. Here is where many candidates get tripped up. They see beta inside the KPM formula and in interviews they just recite KPM. But beta is not calculated from KPM. In practice, we estimate beta in two ways. For public listed companies, we do regression. We take historical stock returns and regress them against market returns, and then the slope of that regression is beta. For private companies, we use industry peers plus Hamada equation to find out beta for the private companies. So this is the Hamada equation where beta L is levered beta and beta U, which is unlevered beta, also known as asset beta, into 1 plus 1 minus T into D by E. D is debt, E is equity. So how do you estimate beta for an unlisted company? Using Hamada equation and the comparable peers. First, identify comparable listed companies in the same industry. Second, take their observed beta, which is levered beta, and this is generally available across websites like Yahoo Finance or Google Finance. Then try to get unlevered beta from here. So we have Hamada equation, so which is beta levered beta unlevered plus 1 minus T into D by E. So we have beta levered, we know the capital structure of listed companies, we know the tax rate. We will try to find out unlevered beta of all these listed companies. Then average them to get industry unlevered beta. So we will have average industry unlevered beta. Fifth, now you have average unlevered or also known as beta asset. Relever it. Use the capital structure of that company. Find out the beta L again using Hamada equation. So now you will use beta U. This is the average industry unlevered beta. And then 1 minus T D by E. Here this is for the private company, capital structure for the private company, you have tax structure for that company, industry beta asset, and then you can find out beta L for private company. And that's the way to estimate the beta for private companies. Now, given that you know the formula, here is a quick check for you. If a company increases its debt, what happens to its beta, and what does that imply for its cost of equity? Think about it and drop your answer in the comments.
And that's a wrap for today's video. We have covered some core accounting and corporate finance questions that come up again and again in interviews. If you got value from this, please like, subscribe, and drop a comment to the questions I have asked. See you in the next video. Thank you.